Welcome to All About Money on HK-IBC. I'm Chloe Finn. In his latest policy address, Chief Executive John Lee has rolled out a raft of measures to boost the economy. He cut stamp duty to revive the property market, made adjustments to attract foreign talent, and encouraged childbirth to encounter the aging population. But just how effective will the measures be? We're joined by Gary Ng, Senior Economist for Asia Pacific at Natixis, as well as James Wong, CEO of Cathaysia Securities, to discuss the specific measures. So welcome both. Thank you for joining us.
Thank you for having me.
So first thing first, let's get your thoughts on your overall impression for the policy address this time. So what are the most impactful measures from your point of view? Maybe we can kickstart from Gary?
Sure. So I think if we look at, what the policy address is trying to deliver, indeed it is a reboot to the economy, which has been experienced quite sluggish growth in the past 3 years. However, if we look at the details, the focus seems to be on the growth opportunities, which is related to attracting investment and also some relaxation in real estate measures as well. But beyond that, I would say that most of the other measures are more on a directional purpose, but really without really much details in facilitating, like a further expectation about, what should come in the future. This policy address seems to be a bit below expectation beyond what we see on finance and real estate.
All right. So what about you, James? What do you think?
Yeah, I think it covers a lot of areas, and by the level of complexity and the details provided in certain areas of the policy address, we can see what the real focuses are. But the point is, I don't think that the financial markets really are buying into this policy address, because we can see the performance on the stock market yesterday and today, and it was not ideal. And I think the main problem with the reformation on stock market or financial hub as a part of the policy address is that people think it is good to having cut the stamp duty, and it's not enough. So that's probably the main concern.
All right. But speaking of, for example, the stamp duty cut, it was reduced from the 0.13% to 0.1% for each transactions. And this is what the market have been calling for as well. Do you think it could pose some effects in revitalizing the stock markets? What do you think, Gary?
Well, I think indeed, if we look at the Hong Kong equity market right now, stamp duty is not really something that is the core factor that is dragging the performance. Because if you look at what happened in the past 2 to 3 years, it's really the policy risk that is the major drag towards the general performance in the market. So therefore, even if there's a certain cut on stamp duty right now, it doesn't mean that investor will rush into the market at the moment. So therefore, I see this as very limited, help to actually support the market at the moment. We need to see a stronger approach from Hong Kong to actually negotiate with the Beijing government in terms of how to provide more opportunities through the Connect schemes, or basically how to reduce the regulatory risk.
Just follow up on this. What do you think are the core reasons that we're seeing the unideal market performance in this year?
Well, I think if we look at what happened in the past years, the major shock to Hong Kong is really about the real estate shocks from China on the bond market, and also about this broad regulatory changes towards the internet platforms, which also form a large part to Hong Kong's equity market. So when you have all these core sectors being hit by regulatory crackdown, then of course investors will try to step away from Hong Kong at the moment, at least from a cyclical perspective. So I think we really need to see a core change in terms of this perception of how investors view Hong Kong versus other market until we actually see any rebound in the future. So cutting stamp duty will not be enough.
So the game changers sort of still be from Beijing then. What do you think, James? Even though you think the effects could be limited, but then the authorities are also announcing that they will reform the smaller board of GEM. Combining all of those measures together, do you think this could offer any help?
It could, but they could have done a lot more. I totally agree with Gary. The macro environment is something that we cannot change, or the Hong Kong government can change. The thing is, they can do more in terms of technicality. So Hong Kong always has been a high-friction money market. So for example, if we compare the trading cost, which compromises of government cost, which is stamp duty, and exchange cost, and by bid-offer spread, we can see that Hong Kong is probably ranked number 3 among all other major exchanges in the world. And we can compare Hong Kong with New York Stock Exchange and NASDAQ. They don't really have stamp duties. So that's a huge difference. The total trading cost before this cut for Hong Kong equity is about 62 bips round trip. And for New York and for NASDAQ, it's about less than 10. So that's a huge difference. By cutting the stamp duty 3 bips both ways, we can have our trading costs in total comparable with that of SGX, but that's about it. SGX is still a high friction money market. So I think at least they can do more is not to just revert the current the stamp duty status back to when before it was raised. And but again, I understand there is a dilemma facing the Hong Kong government because they have their 12% of fiscal income coming from stamp duty of stocks. But I think they think that at this point, while the outside factors it is out of our control, we can still do more on the stamp duty tax, at least to lower the trading costs for institutions, because Hong Kong is still largely dominated by institutional investors. And I think we have 3 occasions in the history of Hong Kong that the governor or the chief executive has appointed the Secretary of Finance Services to assemble a task force to examine the stock market in Hong Kong. Once in 1987 after Black Monday, once in 2003 after a collapse of a cluster of small cap stocks, and this time. So both of those 2 occasions, we have this task force coming up with a report. It took them about 6 months, and then it took the government about 6 months to a year and a half to implement those measures recommended in the report. But this time, we have this task force assembled at the end of August, and apparently they have completed their research and published a report before the policy address, which means it took them only 2 months, less than 2 months to come up with this report. So the only thing that is actually visible in the policy address is a small cut in the stamp duty and the narrowing of bid-offer spread and all those measures. We are now only seeing a directional change. We do not really see how it is going to be done and how to implement them, and if there is any visible time frame. So that's, I think, that's a little rush for this task force to publish this report, and I look forward to see more coming out of them.
Actually, the review is still ongoing, right? Because Chief Executive Zhang Li also signaled that, for example, other calls on the opening up of trading under poor weather could also be implemented later on. The authorities are now studying how likely that we can conduct such measure. But how feasible do you think it is that we could possibly open up trading, to boost the transactions as well during the poor weather?
So I think this is probably one of the measures that seems to be more solid, because if you have the market open, it, of course you will have more turnover. I think there's no question about it. And of course, if you look at the situation of Hong Kong, the reason that Hong Kong has these measures from the very beginning is because of the weather condition in Hong Kong can be quite unpredictable in summer. And at that time, actually, the digital infrastructure is not as strong as what we have right now. But of course, what has changed is also about whether, especially after COVID, is about whether institutions and also other investors are able to trade like in a very smooth way, even under this extreme weather. Then of course it will take like a collaboration or like basically the assessment of how different institutions can actually work together to ensure this is going to happen in a very smooth way. But I think this is definitely the right direction to go if these challenges are being tackled. I think it's very rare that we see such basically trading halt in other markets, around the region.
And especially when across the border, Shenzhen, they can, we're quite close, like in the geographical proximity as well, and they can conduct trading. Why can't we do that? So what do you think about this, James?
Yeah, as a person who oversees a small brokerage, I can tell you where the difficulty lies. Where the difficulties lies. It's because for a person outside of this business, it's natural to assume that it's only so convenient just to do everything online. But the thing is, we need to have a secured connection with the seekers to do clearing every single day. So right now, I think a lot of the small to medium scale brokerages, they do not have a secured connection with the seekers. This, if they are to install a secured connection, like I've said, it means more cost for them. So by implementing the measures to carry on trading when the weather is bad, it means the government or the Hong Kong EX is going to come up with a solution for small to medium-sized brokerages to solve this cost problem. So that's the thing.
Also on the property market, there are also significant measures on this sector as well. So Gary, I want to get your thought. Do you think the stamp duty cost on the property side could really revive a troubling sector we're seeing right now?
Well, I think we would see this change in policy as a more partial relaxation because the government seems to still have the concern of the home affordability in mind, and basically they are not too worried about a very drastic decline in home price as long as it doesn't really threaten the financial stability. So I think this is where we are right now. So given the measures that we see, I think it's more likely that transactions will probably increase because I think obviously there are a group of buyers who want to buy, and there are also more sellers that are willing to sell because of this lower cost as well. But at the same time, whether this will actually fuel another round of home prices increase, I think I would be more hesitant in saying so, because definitely stamp duty is one of the costs that people need to consider when buying home, but there's also other factors affecting the home prices as well. For example, we have the looming new supply coming up, interest rate is still rather high, and the economic uncertainties is still rather challenging in Hong Kong as well. So all of these factors will play out, and therefore I think it's still quite likely that we will see a further decline in home prices, even though the government try to stabilize it.
All right, hold that thought both. For now, we'll take a short break, but coming up next, we'll continue our discussions on the new opportunities arising from the Chief Executive's policy address, as well as the baby's subsidy. So don't go away. Well, welcome back to All About Money on HK IBC. I'm Chloe Pham. Joining us tonight are Mr. Gary Ng, Senior Economist for Asia Pacific at Natixis, as well as James Wong, CEO of Cathaysia Securities, to discuss Chief Executive's policy address. So great to have you both. Earlier, we have touched on the major stamp duty costs in the property sector and also on the stock market as well. Now, I also want to get your thought, because one of the spotlights that many people are discussing right now are the baby's subsidies. There's a one-off newborn baby bonus of 20,000 Hong Kong dollars for each child born on Wednesday or after to a permanent resident parent. And this measure is set to last for 3 years. I mean, Gary, this is one of the policies that is set to reverse the aging population, also to slow down the declining birth rate. But what is the economic sense behind it? Do you think this measure will really be effective?
Well, indeed, if we look at the policy, I understand where it is coming from, because it's all about giving more incentives for people to have more kids. However, if we only look at the subsidies, whether this is fully enough to actually encourage that to happen, I don't really think so, because no one is gonna have a kid because of 20,000 one-off subsidies. But of course, we also need to acknowledge that there are more measures that the government is trying to do. For example, trying to help parents to actually get a home or a subsidized home basically in a prioritized way, etc. But the problem here is that if Hong Kong doesn't really have the the availability of this home at the moment, even though you are prioritized, it still means that you need to wait for 3 or 5 years, etc. So therefore, I think definitely the direction is quite clear, but how it is being implemented doesn't seem to be quite strong or adequate enough to actually fulfill this goal. So I'm not too optimistic about the outcome of the current policy.
Right, especially there are also some analyses saying that now if you want to raise a child in Hong Kong, you probably need 6 million Hong Kong dollars, and now we're only having the bonus of 20K, so it's really a tip of the iceberg as well. But what do you think about this, James? I mean, the initiative is to set a new direction that we are encouraging more childbirths in Hong Kong.
Yeah, I think their policy stance is pretty clear. The government want people to have more babies because the birth rate is so low, but nah. 20K is not enough for any kind of incentive to have a baby. It's a big thing though, right? So I personally, well, the chief executive himself said it's going to take a while for this for the effect of this policy to be seen. So let's just wait and see.
Right, but on the other hand, when we're giving out these kind of cash incentives, and also we're reducing the taxes from the property sector and also from the stocks sector as well, then we are gonna reduce our revenue as well. And now we are also at a time when the land sales are not really ideal. So how would you assess the government's current fiscal health at present, Gary? And do you think if we're offering such initiatives, then where else could we get those revenues back to the government's budget?
Well, indeed, I think the Hong Kong government fiscal situation is more challenging than ever because of this decelerating growth prospect. And of course, on the one hand, from the expenditure side, I think it's quite sensible to assume that the Hong Kong government will need to spend more on healthcare and also on all the aging-related sectors because of this rapidly aging population, also the low birth rate that we have mentioned. So therefore, the expense is simply going to balloon, especially if we consider that the government is trying to push through 2 mega infrastructure projects in the coming decades. So all of this require money. But of course, on the revenue side, I think some of the traditional channels, such as the stock market stamp duty or even land sales, etc., it's very hard to expect a very strong rebound in the short run. So therefore, I think it's quite likely that the Hong Kong government will need to resort to external financing, for example, bond issuance or even asset securitization, public-private partnership, to actually help it to fulfill all of these policy goals that it's trying to achieve. So I wouldn't be surprised that Hong Kong government will probably need to face a more severe fiscal deficit in the future.
Right, and Financial Secretary Po Chen already signaled that we are probably going to expecting a larger than expected fiscal deficit this year as well. But James, what do you think about our current fiscal health as well? And do you think we could expect the tax reform in the upcoming budget addressed next year?
Yeah, I think Po Chen has a pretty clear stance that he doesn't want the taxes revenue to go down. But the thing is, if we do not do anything to boost the market sentiment, the things could get worse. So I think he's making some kind of compromise, but I don't think it's going to last long. Because remember, last 3 times when the Hong Kong government cut stamp duty for stocks, it was in 1993 from 1998 to 2001. All of those 3 years, Hong Kong government is enjoying a budget surplus. So right now the situation could be pretty hard. It's like putting the Hong Kong government in between a rock and a hard place. So I think they are facing some kind of problem.
And now authorities are looking for new drivers as well. For example, Chief Executive Zhang Li is signaled that he wants to transform the city into 8 centers covering those shipping, finance, and culture as well. And he also wants to develop a so-called headquarters economy. So he wants to attract more companies to establish their headquarters into Hong Kong, basically to continue attracting those businesses and talent into the city. And one of the selling points will be the foreign staff of overseas companies registered in Hong Kong will be able to apply for a single visa allowing multiple entries to mainland China. Do you think this feature will be attractive enough to attract those companies to come here?
Well, I think if you look at the past policy address for many years, we have heard Hong Kong government trying to develop many centers, and I think this time there's not really something very different. And of course, when we talk about center, it's all about the ecosystem that Hong Kong has actually from the beginning. Like if you look at finance, if you have all this liquidity and the basically the synergy, then you will have all the professional services surrounding it. It's the same for airport and logistics and other sectors. So I think this strong push into this sort of centers doesn't really address the core problem. Is that when there are opportunities in Hong Kong, then business will naturally come. So it's not really about forcing or like trying to divide Hong Kong or like promote it into different centers and etc. Of course, the government can try to promote it and to make it easier for business to basically earn money here. But the core problem is that the long-term growth in Hong Kong seems to be more challenging than if this is the case, and together with the geopolitical risk that we already see a lot of companies moving out their headquarters away from Hong Kong in the past 3 years, the only increase is really coming from mainland China. But if we exclude that, actually we still experience a decline. So I would say the government will need to work much harder on attracting all this capital back rather than simply having a very weak slogans in terms of trying to develop this sort of centers, of which we have heard many times.
And also there are reports saying that it seems that we are covering too much areas as well. There's a lack of a specific selling point. If we could just focus on one of the features, what would that feature be from your point of view?
Well, I still think that finance is
our niche.
Yes, I still think that finance is really the core, like a driver of the Hong Kong economy. Because if you look at all the services or all the industry actually revolving around the financial market in Hong Kong, I mean, it's really rather huge because you can think of the legal industry and also the IPO and also basically different type of services, even related to the like the MICE economy, which Hong Kong is trying to push in terms of exhibition, etc. But all of this basically require, this a strong role in the financial sector and also this logistical hub. I think anything around that will actually be something very positive for Hong Kong. I mean, even if we talk about technology, it's more likely that Hong Kong will be more successful in financing these tech firms rather than developing itself. I mean, at least from what I see in the past 30 years.
What do you think, James? And also, do you think authorities are doing enough to attract capital as well? And also, we have the investment capital entrance schemes. Do you think such a move will also offer new opportunities for the city?
Yeah, that scheme is not going to do much for immigrants because it's way too high. $30 million, I don't think people can do through other schemes at very, very much lower level of capital. But that's one thing that I think it could be good for the bond market, for secondary market, for the Hong Kong stocks, because $30 million, even if you have $30 million at your disposal, is way too much to spend on Hong Kong stocks in a single bet. So I think it's going to be more and more projects that focused on using this amount of money to invest in bonds that guarantees a return. So that's one thing. And for other things that I think they can do more is, first of all, I'm kind of disappointed that they didn't cover Web3 or crypto. So that's not one of the 8 centers that they were promoting. And that's actually, I think, one of the breakthrough points that Hong Kong could stand out from other major cities or regions. But no, we didn't get much of that except from the digitalization progress for the Hong Kong government. And that's one thing I'm kind of disappointed. The second thing is to fight for talents. I don't think it's really a time to fight for talents over other nations or regions. It's more of a time to retain talents here in Hong Kong, because talent exodus is a harder process to revert compared to capital exodus. And take an example. One of my friends runs a algo company, and he's very enthusiastic about making his company the first in Hong Kong to offer a algo supermarket. And he did get some level of government funding from Hong Kong, and then he went to Tokyo and he went to Seoul. In South Korea, the Seoul government helps him to start a company totally cost-free and help him to hire 2 local Korean college graduates, again, cost-free, and rent him an office, again, cost-free. So that's how you retain or fight for talents. This level of support for talents or for new businesses are rarely seen in Hong Kong. I think they can do more about that.
Retaining talent as well. And what do you think, Gary? Do you think there are new opportunities arising from the policy address as well? And what do you hope authorities could do more? The areas that you think probably are neglected, and you hope to see more measures on those later on.
Sure. So I think if you look at the policy address, I don't really see anything that is too new. I think most of the the policies has been rather similar to what we have seen in the past. I would have expected more measures to facilitate any trade related to the yuan and also more, policy supporting the green transition and financing. But obviously, we haven't really seen much like development into these two areas. And especially last year, Hong Kong has actually mentioned that it aims to develop itself into a carbon trading center. And of course, from the financial perspective, there can be many products that can be offered to basically build Hong Kong as a hub. But again, we haven't really seen very promising, initiative from these two areas, which I think they should be focusing on that.
All right. Thank you very much for both of your thoughts. Appreciate your time. So that's Mr. James Wong, CEO of Cathaysia Securities, and Gary N, Senior Economist at French investment bank Natixis. And this is also the last episode of All About Money for now. For those who tuned in over the past years, thank you very much for your support. I hope you enjoyed our program. So in one of the last goodbyes, until the next time, please have a good night and take care.